Thank you for joining Money Simplified, your guide to money and mutual funds, presented by Franklin Templeton Mutual Fund. We appreciate your participation. At PersonalFN, we are committed to help investors achieve their financial goals and objectives. Our core proposition is built around unbiased research and financial planning. We wish to thank Franklin Templeton Mutual Fund for partnering with us in this investor education and awareness initiative. Welcome to this special series on life goals brought to you by Money Simplified, your guide to money and mutual funds. We are glad to have you with us for a second session on tax planning, and that is tax planning options for aggressive investors. Alright, so let's get started. Often many individuals wait till the 11th hour to do their tax planning. Feeling the heat to do tax planning as the financial year draws to a close, they buy any and every tax-saving investment product without really recognizing what's the most appropriate for them. In the bargain, this leads to mere tax saving rather than tax planning. Under tax planning, one's larger financial plan after accounting for one's age, financial goals, ability to take risk, and investment horizon are considered. Hence, it is vital to complement tax planning with investment planning so that financial goals can be achieved holistically. In this session of Money Simplified, we will explain how aggressive investors or risk takers can go about doing the tax planning. Tax planning options for aggressive investors. So let's begin with our today's session, and first let's understand who can be classified as an aggressive investor or a risk taker. Typical traits of an aggressive investor: he is typically young, has a high source of income, has created or is in the process of creating considerable assets, is willing to accept the risk of short-term losses to create long-term wealth, has limited liabilities, is not supporting many dependents, and most financial goals are far away. Tax-saving investment avenues for aggressive investors. If you match traits of an aggressive investor or one who can afford to take risk, market-linked tax-saving investment instruments would be suitable for you. Market-linked tax-saving instruments invest in capital markets and offer a variable rate of return. The returns aren't fixed. Let's discuss the market-linked tax-saving instruments which you may consider. Number 1. Equity-linked savings schemes, also known as tax-saving mutual fund schemes, are by far popular amongst individual investors and ETFs who intend to create wealth through higher inflation-adjusted returns. A distinguishing feature about them are they come with a lock-in period of 3 years, they require a minimum investment of Rs 500 and can be made with no upper limit, both lump sum and SIP mode available for investing. If SIP mode is opted for the benefit of compounding and rupee cost averaging, each unit will need to complete the lock-in period. Withdrawals are allowed post-lock-in, and dividends and capital gains are tax-free. The amount invested in ELSS qualifies for a deduction under Section 80C of the Income Tax Act 1961 up to a sum of Rs 1.5 lakh per annum. While selecting equity-linked savings schemes, you may give importance to those which have completed at least 5 years of track record and are from mutual fund houses that follow strong investment policies and processes. Don't get lured just by returns, because there's more to evaluating a mutual fund scheme than just returns. Pay attention to risk taken to generate the returns, portfolio turnover, expense ratio, and other portfolio characteristics. Then the next one is unit-linked insurance plans. These are market-linked investment instruments offered by insurance companies. They have a lock-in period of 5 years. The capital gains post-lock-in are tax-free. Minimum investment of Rs 10,000 is required. But ideally, insurance and investment needs should be dealt separately via term insurance and mutual funds respectively to ensure optimum insurance coverage. The premium paid for ULIPs qualifies for a deduction under Section 80C of the Income Tax Act 1961, subject to the maximum eligible amount of Rs 1.5 lakh per annum. Also, at maturity, the amount received by you or your beneficiary is exempt from tax under Section 1010D of the Income Tax Act, subject to specified conditions. Next is National Pension System, or NPS. One can voluntarily contribute or invest in National Pension System through various intermediaries so as to build a retirement kitty. There are two accounts, Tier 1 and Tier 2. First, let's understand the Tier 1 account. In this account, minimum investment is Rs 500 per contribution and Rs 6,000 a year. Minimum one contribution in a year is required. Premature withdrawal is not permitted before you attain 60 years of age. If one retires before 60 years, then 80% of the amount accumulated has to be utilized by you to buy a lifetime annuity. After 60 years, 40% of the amount accumulated has to be utilized to buy a lifetime annuity. Now let's come to the Tier 2 account. For opening this account, minimum investment is Rs 1000 per annum. Minimum one contribution in a year is required subject to a minimum contribution of Rs 250. If you open an account in the last quarter of the financial year, you will have to contribute only once in that financial year. You will be required to maintain a minimum balance of Rs 2000 at the end of the financial year. Moreover, in order to have a Tier 2 account, you first need to have a Tier 1 account. Tier 2 account is a voluntary account and withdrawals will be permitted under this account without any limits. Even if you hold both the NPS account, only the Tier 1 account is eligible for tax benefits. As an investor, you have two investment choices, active or auto. Under the active option, you have a choice to decide the asset allocation to equity E, credit risk-bearing fixed income instruments C, and government bonds G. As an aggressive investor, you should ideally be investing in equity. But the maximum allocation to equity is capped at 50%, which is a limitation for someone who is young and can afford to take risk. If you offer auto choice, money will be invested in these asset classes in accordance to the predetermined asset allocation and age. Non-resident Indians can also participate in NPS. If you are a salaried individual, a deduction up to Rs 1.5 lakh can be claimed under Section 80CCD subclause 1. An additional deduction can be claimed under Section 80CCD subclause 2 if there is any contribution made by the employer, but only up to 10% of the salary. For this purpose, salary constitutes to be basic salary plus dearness allowance. In the Union Budget 2015-16, the government inserted a new subsection 80CCD subclause 1B in Section 80CCD, which provides an additional deduction of Rs 50,000 for contributions made by individual assessee under NPS. In case of NPS, capital gains are taxed on withdrawal. While NPS enables investors to plan for their retirement needs, it may not be able to meet all retirement needs. Hence, holistic retirement planning would be needed. Then Rajiv Gandhi Equity Savings Scheme or RGSS. RGSS was introduced in the Finance Act 2012 under Section 80CCG, which provides for deduction for investment in RGSS. One can avail a deduction under RGSS scheme provided you are a new retail investor who complies with conditions of the scheme and whose gross total income for the financial year in which the investment is made under RGSS is less than Rs 12 lakh. New retail investors inter alia shall mean any resident individual who has not opened a demat account. The maximum investment permissible for claiming deduction under RGSS is Rs 50,000. As an investor, you would get 50% deduction of the amount invested from the taxable income for that year under Section 80CCG. The benefit is in addition to deduction available under Section 80C. Investments are to be made directly in eligible listed equity or follow-on public offer of such listed equity or into units of mutual funds and ETFs. The total lock-in period for investments under RGSS would be divided into fixed lock-in period and flexible lock-in period. The initial period of lock-in shall be known as the fixed lock-in period, which shall commence from the date of purchase of securities in the relevant financial year and end on 31st day of March of the year immediately following the relevant financial year. A new retail investor shall not be permitted to sell, pledge, or hypothecate any eligible security during the fixed lock-in period. The period of 2 years, beginning immediately after the end of the fixed lock-in period, shall be called as the flexible lock-in period. Upon completion of the fixed lock-in period, new retail investors will be allowed to trade in eligible securities. Investors would, however, be required to maintain the level of investment during the next 2 years, that is, the flexible lock-in period, at the amount for which they have claimed income tax benefit or at the value of the portfolio before initiating a sale transaction, whichever is less, for at least 270 days in each of these 2 years. Such investment value shall exclude the value of investment which is under fixed lock-in period. Here is a snapshot of the market-linked tax-saving instruments which we discussed. First, equity-linked savings schemes. Next, unit-linked insurance plans. Thereafter, National Pension System or NPS and Rajiv Gandhi Equity Savings Scheme or RGSS. Here are the final points to remember. Don't wait till the 11th hour to do your tax planning, as by doing so, you'll buy any and every tax-saving investment product. Market-linked investment products which clock a variable rate of return are suitable only if you're a risk taker or an aggressive investor. You can start investing in ELSS with as little as Rs 500. ULIPs offered by insurance companies look at both insurance and investments, but ideally consider separating insurance and investment needs through mutual funds and term insurance. Even if you hold both the NPS accounts, only the Tier 1 account is eligible for tax benefit. Only new retail investors whose gross total income in a financial year is less than Rs 12 lakh can invest in RGSS. And last but not the least, complement tax planning and investment planning. So to end our learning exercise today, we now invite you to test your learning by taking up the simple quiz and win exciting prizes. Thank you for participating. Mutual fund investments are subject to market risks. Read all scheme related documents carefully.